Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Yesterday was an interesting day on two fronts. We had the Japanese policy and the European inflation data. While the Japanese policy broadly remained as it is, there were a few changes that resulted in a sell off in yen, with the pair crossing the 150 mark. European inflation, on the other hand, sank to a 2 year low, with CPI sinking to 2.9% in October. But now, of course, the focus will shift towards data coming out of the US and the FOMC. Hi, JK. Help our listeners understand the Japanese policy decision and your thoughts on the Eurozone inflation reading.
Good morning, Swaraj. Japanese monetary policy, of course, keeping rates unchanged, that was not a surprise. And even for me, their statements or the decisions were not as dovish as the market took them out to be. BOJ further loosened their grip on the long-term interest rates by tweaking its bond yield control policy, taking another step towards reversing the controversial monetary stimulus of several years. Now, it will keep the 10-year bond yield around 0%, set under the yield control, but redefine the 1% as a loose upper band rather than a rigid cap. This would mean that, if it starts going above 1%, it may not be resisted to the extent that market would normally expect. It also removed a pledge to defend the level with offers to buy unlimited amounts of bonds, etc. But somehow the investors read it as a dovish pledge, and probably they were expecting a lot more hawkishness from Japan. So they went out selling yen, almost taking it to the previous high that was seen in September 2022. 151.71 was seen yesterday. And the feature of it was that all the yen crosses were higher. Now, looking at what the governor said, he signaled that Japanese central bank was in no rush to end yield curve control or the negative interest rates, even though Japan was making progress towards sustainably achieving 2% inflation. In fact, the major part of the yen move came after the Ueda's press conference. Now after a lull, we have been having a stream of data, and mostly from Europe. And we had the Eurozone GDP that also came lower than expected at 0.1%, following a drop of minus 0.1% in Germany. And this also follows a weak inflation number from Germany, as well as the Eurozone inflation data coming lower than expected. Although the core price was still somewhat slowing at much slower pace, but the headline number was definitely a big surprise to the downside, coming at 2.9%. Now, all these things actually reiterate the fact that ECB may be close to a peak in their rates, and must be actually looking at supporting the consumption, which has been actually a drag on their growth. Now, if you look at how the relative economies have been performing, it has become almost a practice to talk about US exceptionalism, and it has been in display of late. US GDP came at 4.9%, Eurozone GDP came at 0.1%, and then in US the consumption has been driving the growth, and in Eurozone consumption has been dragging the growth. And then we had the yen rather going up on the loose monetary policy that is continuing broadly from BOJ. So that's how. Then we had more evidence from US, and the significant number was the unit labor cost in the US that came at 1.1% in the last quarter, after rising 1% in April, June. Now, you can look at it in two ways. The higher number obviously means that the wage inflation is still persistent, but it was for the third quarter, which ended 1 month before, that is in September. Therefore, in October, they might well have been moderated because of higher interest rates. Then we will look at the ADP payroll data today, and also the JOLTS data, and more to come tomorrow and after, before the NFP number as well. We had another piece of data from US. Home price growth accelerated for the third straight month in August. Now, once again, this is backward-looking data, not giving much importance, but the important number was the consumer confidence that showed a further decline in the US economy. Confidence declined from 103 to 102.6 in October, compared to expectation of 100, of course. The present situation declined from 146.2 to 143.1. And the survey responses showed that consumers continue to be preoccupied with rising prices in general. Now, it also needs to be understood that historically expectation index readings below 80 levels signal a recession within next 1 year. In the Asian time, we had the Chinese PMI data that came below expectation at 49.5 versus 50.2 on the manufacturing, 50.6 versus 51.7 on the non-manufacturing side. But there's a rider to it because China had a long holiday in October, first week, and that could have impacted the activity level. So I would rather be looking at next month's data than looking at these numbers. On the markets, stock markets actually have been quite positive of late, taking cues mostly from good earnings reports and also oversold conditions prompting a lot of short covering ahead of Fed policy announcement and the jobs data. However, yields remaining high and the influence from the Treasury refunding announcement due today keeps the investors cautious. The Treasury announcement in particular is likely to boost the size of auctions for bills, notes, and bonds in the fourth quarter to fund a widening budget deficit, and this could cause a further rise in the yields. The 30-year yields on overnight rose by 5 basis points and 10-year by 4 basis points. We remain skeptical that the rates have topped and the next up move could be waiting for the Fed event to be over. On the currencies, yen-related moves dominated the market yesterday, as we saw selling in yen after the BOJ policy decision, particularly after Ueda's press conference. We made a new 15-year high in the euro yen at 160.85. It has since then stepped back. Euros, while it stayed initially supported due to cross-buying, eventually caved into selling pressure at data from Eurozone has been quite underwhelming. GBP is marking time ahead of UK rate decision tomorrow. The forward conditions have ultimately weighed on gold prices, which has fallen sustainably below 2,000 now and is seen consolidating ahead of Fed and NFP on Friday, even as the news from the war front has not been so much of a concern, or rather I would say it has not escalated to the extent that you see gold prices being further pushed higher. Coming to the rupee, on a day when the spot rupee moved in one of the narrowest ranges at 2.5 paisa, we did see a relatively much larger move in the premium. Premiums have fallen to 134.5 on the 1 year from 139.5 on the previous day, and this is with a gap down, and it's just staying 5 paisa above the recent low in the premium. Significantly, this fall has not occurred with any rate differential movement between India and the US, and it is mostly put down to the dollar shortage that the market is experiencing, with all the supplies coming only from RBI, coupled with a very consistent outflow seen for several weeks or months, I would say. In the past, we have seen that such fall in dollar availability results in a bigger move in the spot USD-INR. So we will be observing the behavior of forwards in the coming days, as well as the flow situation. Thank you.
Thank you, JK. And just to quickly summarize the Japanese policy, even though the rates were unchanged, which is not a surprise, BOJ did tweak their bond yield control policy. The upper band of the 10-year, which was set at 1%, would more be like a line in the sand rather than a hard line. The Eurozone inflation data coming in lower than expected. This is interpreted as ECB reaching somewhat of a peak rate since inflation isn't that big of a concern, along with now the concern shifts to more of slowing growth in the region. As a contrast, if we see the US data, it has been stronger on a relative basis, which has kept the dollar buoyant. Gold prices have fallen below $2,000 an ounce as geopolitical situation hasn't worsened. For rupee, we moved in a very narrow range yesterday of 2.5 paise, but as JK mentioned, premiums has fallen quite a bit. 1 year at 1.34, This is due to a possible dollar shortage in the market. So this might be this can possibly cause a big move in the future, as JK mentioned. We'll keep an eye out for that. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.